Okay, in previous video we got understanding what is options by its sense. So it is insurance, some analog of insurance for less. And today we're going to cover types of options. Let me show you what we have. Let's let's get started from the style of options. We have two style of options. It's American style and European style. The main difference between them is in expiration time. Actually, not expiration, by time of exercise. So that means time of doing all calculation. So we will get current market price, we will calculate difference between our initial price, our strike price, and so on so far. So we will do all calculation, and this is what exercise of options mean. So in European style, for example, let's get back to parameter of any option. So what we have strike price. We have strike price. For example, in our previous example, it was hundreds of dollars. We have premium $75, and we have expiration time or period of insurance. In options it calls like expiry or expiration date. Okay, let's think that it is in 1 year from the date of option was bought or sold. So this is measure simple features of every options. Also they have Greeks, also they have some implied or real volatility, historical volatility, and so on so far. A lot of things, because it's non-linear asset. So return to European style option. European style option supposes that you can exercise option only in certain defined period at the certain date. For example, it could be September 30 of this year. So at this date, at some particular time, broker will do all calculation and will deliver to you asset of option, or just some cash value of option calculation results. It will be explained in this point. So European style option supposes that we will exercise option only at the expiry date. It doesn't mean that we can't sell this option to another person before that date. You can sell, buy options in any time, any date, if you have enough liquidity in the order book. But expiration time and exercise of option will be done only exactly at the same time of expiry date of option. So American type of options suggests that we can exercise option at any time. No, not actually at any time. Usually brokers have, for example, 2 times per day when you can exercise options. Basically, it's clearing sessions. Usually it's day clearing, intermediate clearing, and evening clearing, which is main clearing session. So all you have to do is send broker messages. Okay, I would like to make exercise of these options, and it doesn't matter that today is, for example, July 20th. And broker will awaiting the first possible clearing session and will do exercise. But usually it's not so much efficiently from P&L side, because options have some inner cost which is linked with time which is left to expiration, and then more time of expiration, then more inner value it has. For example, we paid $75 as premium, and the real inner part of this premium, for example, $50, because options has, for example, 3 months before expiration, and this is what you will lose in case if you will do exercise before expiration time. So it's usually it's more efficient just sell this option instead doing expiration. But sometimes it is useful if price, for example, went too far in your favor, and you have no enough liquidity by adequate prices to sell the option. I had the same situation on our currency pair when it was hardly defaulted to USD. So basically I have no any buying liquidity to sell my option, and fortunately I had American style option and I did execution exercise of option, and yeah, I lost probably 0.001% of PNL, of gross PNL, but my total PNL was so high that it wasn't matter for me. I wanted just get my profit pocketed in my wallet, and that's all. So I asked broker to exercise my options and pocket my profit. So sometimes it can be useful, but in most of case you have most efficient way just sell your option to another guy, then exercise it. So let's take a look to settle type of options. Since options is basically agreement about delivery, or in other words, buying or selling some underlying asset, we have two types: cash settled and physically settled. cash settled means that when you will go to exercise of options, broker will do all calculation and just get some P&L of your option and underlying asset construction position, and will put this value in margin currency to your account. Put in cash to your account. So usually it happens on index asset, on index assets, which is will be underlying asset for options, because index you can't deliver index to your account as assets. So usually it use cash settled type of options. In case if we have physically settled options, when expiration date will come, broker will do calculation, and for example, if we bought option and have to exercise it, so it will deliver it to our account physically. Account will get physically assets, underlying assets of option. For example, we have no position in and we just buy call option, which looks like this. So this is our break-even point, this is our price when we buy this option, and all this amount is our profit. All this amount is our losses. So in case if we got an execution exercise of option, for example, at this price, this is price, this is P&L, P&L. So at the date of exercise we have a price higher than our strike. So our P&L here. In case if we have cash settled options, we will get just this P&L to our account. In case if we have physically settled options, for example, it was option on underlying share or underlying future asset, we will not get P&L, we will get a real asset to our account, and then after clearing we can just sell this asset and we will get probably this amount of P&L, or probably we can get high amount of P&L in case if price will slightly go up or go down, we will get lower P&L. So this is basically a difference of physically settled and cash settled assets. Now let's take a look to the last classification of options is by direction, call and put. Is a measure terms, measure types of options classification. So call options and put options. Let's split it. Oh, okay, let's do like this. Okay, so call options, it basically the same like when you buy futures or buy share, so it's long position of asset. But it looks like this. This is price, this is P&L, and it looks like something like this. So it looks like if we will buy future at the same time, just for comparison. Let's do like this. Okay, so this is futures, this is options. For future we have delta equal 1. Okay, don't we will not use Greek for this example. Futures, it's just linear asset, so if price goes up, we get some profit. If price goes down, we will get some losses. In options, in call option, if price, here is our buy price, entry price, here we paid some premium, and this is all our losses in call options. This is long direction. Break-even, we have in futures break-even little faster than in options, because this is amount is premium, but the same logic, the same mechanism like in options, but we have strictly restricted stop loss, which is like a premium. Put options is a short position, simply it's short direction. So futures will looks like this. Option will look like this. So here is premium, here is entry price, here is premium, and this is break-even for options. This is futures, this is options. So basically, if you would like to short the asset and you want to place stop loss, which can be hit few times before asset really will go to your favor, so you can use options to trade it directly. It's pretty simple, it's usually quite common and widely used strategy, so feel free to use it. So this is put option, this is call option. This is example when we only buy options, call and put, but we can also sell call or put options. This is highly risky strategy, and basically it looks like opposite situation. When we have call option as sold put option, we make a bid to short direction of underlying asset, short, and we will make bid to long direction if we sell the put. Sorry, let me show you. Okay, let's start from the call. This is P&L. this is price, market price. So in case if we will sell call, we will get also, okay, let's start from the futures. So if you short the futures, we will get situation when we go below our short price, we are in profit. If we will go upper, we are in infinity loss. Actually, we just waiting when we will get margin call. So in case if we will sell call options, we will be in profit all the time. This is our premium, this is entry point, this is break-even point options, this is premium. So, and this is amount is premium amount as well. So that means that we are in profit until price will not grow up until expiration date more than initial price plus premium we got from the buyer of option. And basically, usually it will not our option will not be exercised in this period, because it's not efficiently, it's not profitable from option buyer side. So this all is our premium, is our profit, but we pay attention that we have infinity losses in this situation. So now let's take a look to the put options. Put options when we think that price will go higher from our current price, and this looks like this. Sorry. Okay. Sorry, I'm a little bit confused. Okay, like this. So this is premium, it's a futures, it's a put options which is sold. So option, this is premium, this is premium amount also, this is our break-even point. So this is P&L. This time we make bid to price movement forward, movement long. This way we can easily sell the puts, because we think that price will not reach strike of options at the period of exercise. Okay, I found what is wrong in this picture. Let me fix it, please. Sorry. Okay, we have like this. Okay, usually we use software which draw in this all this sheet, and it's a little bit confused when you trying to do this by yourself. Premium, this is premium amount, so this is break-even point, break-even point. But usually this is also our profit point, because usually it's not option will not be exercised like in this situation, because it's not super efficiently super profitable for option buyer side. So this way, if price will go up, so in case if we will buy futures, we will get infinity profit, and if we will sell put, we will get premium restricted profit size. And but in case if price will go in opposite of our favor direction, so we get in both of ways, in future, in put selling. Okay, let's sell put is equal long direction, sell short, sell call is equal short direction. So this means we will get infinity losses and restricted profit. In case of this, we will get the same. Here we get restricted profit, take profit, and infinity losses. That's why selling options is very bad idea if you don't understand how to manage this position in case if price will go to this point. For example, if price will go to this point, you can buy option back, not exactly at the same person, but it doesn't matter. You can buy option back, or you can, for example, open short of futures, and this way you will get something like this situation. So you will get okay, I think this is will be correctly. So your P&L will be like this, just flat line. Sorry, not flat line. Your position will be like this until this will be flat line, and this will be negative line, because you have some profit below here, but then your shorted futures will eat all your profit. So because it's restricted by selling options and you have shorted futures, so you will get basically synthetic sold call. So it's just option position management approaches, and let's put it to further videos.